where you invest your money is almost just as crucial as how you invest your money. And that's why you need to stay to the end of this video, because I'm going to put together everything a step-by-step on where you should invest first and where you should invest last. Specifically, we're talking about what kind of accounts to invest in. Now, the short answer to this is that first, I want you to go after those free money accounts, okay? And we're going to talk a little bit more about that. Secondly, then you're going to want to go after just tax advantaged accounts, okay? And tax advantage is anything that gives you a tax advantage. Any kind of account that gives you, either tax deferral or tax-free something, that's what you're going to want to go after next. And then lastly, number 3, you're going to want to go after those regular investment accounts. Okay, you're going to want to save those for last. After you have utilized getting some free money, and after you have utilized anything that's going to save you on taxes, then you'll want to go to those regular taxable accounts. Now, for the longer answer here, let's go ahead and first discuss what free money accounts means. First off, probably the most common thing that we have access to, that most of us, if we're working in a regular job, we're going to have access to a 401k, and within that 401k, we might have access to a 401k match. So this is the easiest and probably the first thing that you should look for in order to get some free money. Okay, the 401k match is an instant 100% return on your investment. If you put, let's say, 3% of your salary into your 401k and the company's going to match you 3% of your salary, that's a 100% return on that 3% of your money invested. And so automatically you're going to always want to take advantage of the 401k. That's like basics number 1. Like, even if you're not on the path to financial independence, you should always be taking advantage of that 401k match, and tell everyone in your friends and family, make sure that you're taking advantage of a 401k match. Because why? Because that is 100% free money. It's an instant 100% return on your investment. And how much you should do it? Well, you should do it at least bare minimum all the way up 100% to whatever the employer matches. Even if it's not a 100% match, if it's a 50% match, that's still a 50% ROI automatically that year. So always take advantage of that free money 401k match. And then secondly, another one that actually not many people think about when it comes to free money account is actually a employee stock purchase plan, also known as a ESPP. So why would you want to even take advantage of an ESPP? Well, this is actually free money as well. It's just disguised in a different way. Now, not everyone has access to the employee stock purchase plan, and not everyone's plan is that good. But some people, in some circumstances, you can have access to one that is really great. And that's because they might offer you a significant discount on the stock purchase. So for example, a really common one is a 15% discount. If you're getting a 15% discount on the purchase of your employer stock, and you go ahead and purchase that and you get a 15% discount, if you're allowed to go ahead and turn around and resell it right away, that's an instant 15% return. That's almost like getting 15% free money. And as long as there's not something super crazy going on with the markets or super crazy going on with your company, this could be a really good choice. Now, the nuance comes in here when you don't get that significant of a discount. Let's say you only get a 5% stock discount. Well, then it's not as great. It might not be worth it to take advantage of at 5%. It still might be, but it might not be. But at 15%, it's very worth it, because a 15% automatic return, give or take, that's going to still be a very significant instant return. However, some plans don't even allow you to automatically turn around and resell that stock. And if there's a waiting period, and that waiting period is really long, then it might be a little bit too risky to do this. But on the other hand, it might be okay to do it with a little bit of your money. How much you're going to be able to invest in your ESPP is going to be obviously dependent on your plan. Not everyone has one, not everyone has a good one, but generally speaking, the limit is supposed to be $25,000 annually for how much you can invest in that plan. But just keep in mind that since you are going to be selling them right away, and you're not going to be holding them for 1 year, that means you're going to be taxed at the short-term capital gains rate, which is going to be just like taxed at ordinary income tax rate. And so the amount of taxes that you're going to pay on that is going to take away from the return that you're going to get from that. But still, under the right circumstances, the ESPP can be some great free money. The next thing is that you want to take advantage of is those tax advantaged accounts, okay? And generally speaking, there are 2 different tax advantage ways. You can either defer taxes, like with a traditional IRA or a traditional 401k, or you can pay taxes on the money that you put into an account and then withdraw it tax-free in the future, like a Roth IRA or a Roth 401k. However, one way that you might be able to get the best of both worlds of the traditional and the Roth, both in one, is what's known as an HSA, or a health savings account. So if you have a high deductible health savings plan and you're eligible to open up an HSA, then you should definitely do so, because you could possibly get a triple tax benefit. So money that you put into an HSA is a tax deduction. Money within the HSA grows tax-free, and then when you go to withdraw it, as long as you withdraw it for qualified medical expenses, then that money is going to be tax-free. So that's the triple tax benefit that is possible with the HSA. Otherwise, after a certain age, it's almost like a traditional IRA. I do have another video for that explains it a lot better than I'm going to explain it into this video. So make sure if you're interested in learning more about the HSA, you watch that video. And another major benefit of the HSA is that there's no income phase out. So no matter how much money you make, you can contribute to the HSA and you can get a tax deduction for it. Right now in 2021, the HSA maximum contribution is going to be $3,600 if you are single, and then double that if the HSA covers for a family. So that would be $7,200. So $7,200 or $3,600 maximum for an HSA, and that is definitely something that you should be taking advantage of if you can. Another thing that you should definitely be taking advantage of is that like button on this video. Please make sure that you hit that like button if you're liking this video so far. It really does help me out and I really do appreciate that. It also lets the YouTube algorithm know that you enjoy this video and that you want it to be sent to other people. And believe me, other people do need to see this video. So thank you for hitting that like button. But now we can move on to another tax advantage account, and that is the IRA, or the individual retirement account. And this comes in two different flavors. We have either traditional IRA or we have the Roth IRA. And depending on your circumstances, one could benefit you a lot more than the other, or they both can definitely benefit you in some way in most circumstances, but one might be better for your individual circumstance or situation. And this is mostly going to be dependent on what your actual tax bill is now. So if you have a high tax bill, then maybe you're going to want to reduce it with a traditional IRA. If you already have a low tax bill, then maybe you want to get money into a Roth IRA immediately so you can get some tax-free withdrawals later on in the future. Now, I've already done plenty of good videos explaining traditional IRAs and Roth IRAs, so if you need to know a lot more in depth of the difference and when they're going to benefit you, then please make sure that you check out those videos because I explain them in much more detail. But for 2021, the amount of money that you can put into a IRA, either traditional or Roth, is going to be up to $6,000. So up to $6,000 you can either put in a traditional IRA and defer the taxes on that amount of money, or you can put into the Roth IRA and let it grow tax-free and withdraw it later tax-free as well. If you are married, filing jointly, then you can go ahead and double that because it's going to be one per spouse, so it's going to be $12,000. And then there's also a little bit of extra that you can catch up for if you're over the age of 50. And similar to the IRA, since everyone has access to an IRA, anyone can open it up and contribute to it with earned income. Similarly to that, we have the 401ks or a similar plan. Okay, so depending on what kind of employer you work for, you might have access to a 401k, you might have access to a 403b, a 457b, something like that. This is going to be an employer-sponsored retirement plan. So you can only open this up if your employer offers them, or if you're self-employed, then you can open up one on your own. But this is going to be through the employer, whereas the IRA was on your own. Individual opens that up. The employer opens up like the 401k. So for the 401k, you can actually have both options as well. You can have a traditional option and you can have a Roth option as well. Now the difference is that with 401ks, you can contribute a ton, like a lot more money to them than you can with an individual retirement account. In 2021, that limit was $19,500. So you can contribute up to $19,500 in your 401k versus only $6,000 in your IRA. And again, you can benefit in different ways. The traditional, you're going to reduce your taxable income. The Roth, you're going to let it grow tax-free and you're going to get to withdraw it tax-free in the future. So which one's going to benefit you more is going to be highly dependent on your situation, but you almost cannot go wrong in either situation because they both are going to save you a ton of money on taxes somehow. Now, after you've gone ahead and gotten all the free money that you can and you've maximized all the tax advantage accounts that you can, then you're going to want to put money into taxable investments. Okay, this is almost going to be the last thing that you're going to do. You're going to put money in your taxable investments when you can't take advantage of all those other things, generally speaking. Now, your circumstance might be a little bit different, but generally speaking, you're going to want to save your taxable investments for last. Now, why would you even want to contribute to taxable investment accounts? Well, first off, the flexibility. They have unlimited flexibility. You can invest in anything within them, and you can take money out and put more money in whenever you want, and there's no limit because it's just a regular taxable account. Now, as the money grows, you're going to pay taxes on it. If you get paid dividends or if you get paid interest or if you sell off and you realize capital gains, you're going to pay taxes on those immediately. There is no tax shelter around it like with those previous accounts. However, you can invest in certain things that are going to be very tax efficient. So the tax consequences of investing in a regular taxable account, it doesn't really have to be that bad as long as you choose tax efficient investments. And combining that with there is no limit to how much you can invest in there, you can see how with all of these steps, this hierarchy of investing accounts, you can grow your wealth to be very, very high as long as you have a very high savings rate and you're putting most of your money into these accounts rather than just spending it like most Americans do. And if you want to learn a lot more on how to grow your wealth by investing for financial independence, then make sure that you watch this other video that I created. It's a full guide to investing your way to financial independence. So make sure you check out that video if you haven't already. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.